Bismillahirrahmanirrahim. This is the first video on responsibility accounting. In this video, we will describe the concept of responsibility accounting. We will indicate the features of responsibility reports for cost centers. We will identify the content of responsibility reports for profit centers, and we will explain the basis and formula used in evaluating performance in investment centers. Finally, we will solve the exercises comprehensively related to responsibility accounting. Please like, subscribe, and share my channel to search for accounting lessons, and hit the notification bell button to alert you for the latest video. For all of your questions, comments, and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is AK. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. We hope this video helps ACCA, AICPA, CPA, and CMA aspirants. We also hope that this video helps fresh graduates who have joined the companies and want to refresh their learning of responsibility accounting. So let us start with the concept of responsibility accounting. Responsibility accounting is a kind of management accounting that is accountable for all the management, budgeting, and internal accounting of a company. The primary objective of this accounting is to support all the planning, costing, and responsibility centers of a company. It involves separate reporting of revenues and expenses for each responsibility center in a business. This helps in improving the management of operations. For example, the cost of rent can be assigned to the person who negotiates and signs the lease, while the cost of an employee's salary is the responsibility of that person's direct manager. Thus, responsibility accounting is a system of control where responsibility is assigned for the control of cost. The persons are made responsible for the control of cost. Proper authority is given to the persons so that they are able to keep up their performance. In case the performance is not according to the predetermined standards, then the persons who are assigned this duty will be personally responsible for it. In responsibility accounting, the emphasis is on men rather than on systems. For example, if Mr. A, the manager of a department, prepares the cost budget of his department, then he will be made responsible for keeping the budgets under control. Mr. A will be supplied with full information of cost incurred by his department. In case the costs are more than the budgeted cost, then Mr. A will try to find out the reasons and take necessary corrective measures. Mr. A will be personally responsible for the performance of his department. Responsibility accounting collects and reports planned and actual accounting information about the inputs and outputs of responsibility centers. Under this system, divisions or units of an organization under a specific authority in a person are developed as responsibility centers and evaluated individually for their performance. The responsibility centers represent the sphere of authority or decision points in an organization. However, for effective control, a large firm is usually divided into meaningful segments, departments, or divisions. These subunits or divisions of organization are called responsibility centers. A responsibility center is under the control of an individual who is responsible for the control of activities of that subunit of the organization. Budgeting and responsibility accounting together imply providing management control information. This feedback system compares the performance and effectiveness of operating with the plan. It also provides an opportunity for the reappraisal and adjustment of plans. Budgeting helps to determine priorities. Next, let us talk about controllable and non controllable cost. Controllable costs are those over which the manager has full authority. By contrast, non controllable costs are those that a manager has no control. Performance evaluation is at the center of responsibility accounting. It is a management function that compares actual results with budgeted goals. It involves both behavioral and reporting principles. Performance should be evaluated by management by exception and behavioral principles. Let us first talk about performance evaluation by management by exception. Management by exception is a workplace practice that finance and business industries often use. This practice allows employees to only involve their managers on specific issues. For example, an employee who monitors the company's budget may only need to contact their manager if the account falls under a certain amount. It is a well accepted fact that at higher levels of management in the organizational chain, less and less time is devoted to control and more to planning. Thus, an effective responsibility accounting system must provide for management by exception. That is, it should focus attention of the management on significant deviations and not burden them with all kinds of routine matters. Rather, condensed reports requiring their attention must be sent to them, particularly at higher levels of management. Next, let us talk about performance evaluation by behavioral principles. Managers should be directly involved in defining goals of their area of responsibility. Only those performance should be evaluated that are controllable by the manager. Top management should encourage and support the evaluation process. Managers of cost centers should be allowed to respond to their evaluation. The evaluation should identify both good and poor performance. Next, let us talk about reporting principles. The evaluation report must contain only the data that is controllable by managers of responsibility center. The report must provide accurate and reliable budget data to measure performance. It must highlight only significant differences between actual results and budget goals. It must be tailor made for intended evaluation and it must be prepared at reasonable intervals. Next, let us talk about responsibility reporting system. A responsibility reporting system involves preparation of a report for each level of responsibility in the company's organization chart. Let us explain it with the help of an illustration. You can see that it begins with the lowest level of responsibility and moves upward to higher levels. It permits management by exception at each level of responsibility. That means top management focus primarily on differences between actual results and planned objectives. Each higher level can obtain the detailed report for each lower level. Now, in this illustration, you can see that there are three different plants. One is in Detroit, Chicago, and St. Louis. And in Chicago, there are three departments: fabricating, assembly, and enabling. Each department will be preparing their own report, and then they are going to be compiled together for the Chicago plant, and the same process will be adopted by the Detroit plant and St. Louis plant. Now, these are going to be further looked into by the different vice presidents of their respective functional areas, and then finally, the president sees the summary of the vice president reports. Let us see how it is going to be reflected. So, an effective performance reporting system permits comparative evaluation. The plant manager can rank each department manager's effectiveness in controlling manufacturing cost. These comparative ranking provide incentive for a manager to control cost. Like you see, we have we have the fabricating department, and here we have the three costs: direct material, direct labor, and overhead. We have the budgeted figures and we have the actual figures, and they reflect whether the di- difference is unfavorable or favorable. Then the fabricating department report is summarized or concised, and this is for the Chicago plant. In the same way, they are going to prepare the report for enameling and assembly, and then the Chicago plant report is concised or summarized, and then the other plant reports are also prepared. And then the vice president is going to compare these plants, and we can see that only the Detroit plant is functioning favorably while the others are unfavorable. And then these are going to be summarized to the president at the top, and you can see that uh, they identify different areas like sales or production or finance, as the case may be. So, next let us talk about the types of responsibility centers. So, we have three different types. We have the cost center, and it is a unit in a company that has control over the cost only, such as the production department. The cost center does not exercise control over other functions such as revenue or investment. A point to note is that a manager responsible for any cost center is only responsible for the controllable cost and not uncontrollable cost. I would also like to add revenue center, and this unit is only responsible for generating revenues and not any other business function. The sales and marketing department are an example of a revenue center. The second type is the profit center, and profit center is accountable for both cost and revenues. One example of this is the factory, whose cost is the raw material and revenue is the products it transfers to other departments. Also, branches of a company in different regions are responsible for both costs and revenues. The third one is the investment center, and investment center has control over cost, revenues and investment. Or we can say the person is responsible for investing the assets of a company most efficiently. Such a cost center works as a separate entity such as a corporate headquarters. A company measures the performance of an investment center by using ratios such as return on investment, economic value added, etc. So, this completes our discussion on the concept of responsibility accounting. And next, we will talk about the features of responsibility reports for cost centers. So, a cost or expense center is a segment of an organization in which the managers are held responsible for the cost incurred in that segment but not for the revenues. According to CIMA London, a cost center is a location, person, or equipment for which cost may be ascertained and used for purposes of cost control. Responsibility in a cost center is restricted to cost. For planning purposes, the budget estimates are cost estimates. For control purposes, performance evaluation is guided by a cost variance equal to the difference between the actual and budgeted cost for a given period. Cost center managers have control over some, all, or all of the cost in their segment of business, but not over revenues. In manufacturing organizations, the production and service departments are classified as cost center. Also, a marketing department, a sales region, or a single sales representative can be defined as a cost center. Cost center may vary in size from a small department with few employees to an entire manufacturing plant. In addition, cost centers may exist within other cost centers also. For example, accounting department, repair and maintenance department. Responsibility accounting system is focused on performance reports, also known as responsibility reports. These are prepared for each responsibility unit. It is based on a manager's ability to meet budgeted goals for controllable cost. This results in responsibility reports that compare actual controllable cost with flexible budget data. It includes only controllable cost in reports. It is important to note that no distinction between variable and fixed cost is done. Let me explain you with the help of an example. You can see here that there are budgeted goals and we have controllable cost. It compares actual controllable cost with the budgeted data. It do not make distinction between variable and fixed cost. And then they evaluate the difference whether they are favorable or unfavorable. Now in this case the actual cost is more than the budgeted cost, that's why the difference is unfavorable. When we look at the indirect labor, the actual indirect labor is less than the budgeted labor, that's why that it is favorable. When we look at utilities, it is more than budgeted, so that's why it is unfavorable. And when we make the sum, the actual is less than the budgeted, that means our cost is less actually as we have planned, so that's why these are favorable. Next, let us identify the content of responsibility reports for profit centers. Profit centers are also called business center. It is a segment of an organization whose manager is responsible for both revenues and cost. In a profit center, the manager has the responsibility and the authority to make decisions that affect both cost and revenues and thus profits for the department or division. The managers are encouraged to act as if they were running their own separate business. The main purpose of a profit center is to maximize profit by making decisions relating to production volume, product mix, selling price, marketing strategy, etc. Profit center managers aim at both the production and marketing of a product. Here I would like to introduce the concept of direct and indirect fixed cost. Direct fixed cost is related to one responsibility center and is incurred for the sole benefit of the center. It is also called traceable cost since they can be traced directly to one center. Mostly these costs are controllable by the profit center manager. Indirect fixed costs are related to the company's overall operating activities. They are incurred for the benefit of more than one profit center. They are also called common cost since they apply to more than one center. Such costs are not controllable by the profit center manager. Next, let us talk about responsibility report. Reports budgeted and actual controllable revenues and cost. It uses cost volume profit income statement format. It deducts controllable fixed cost from the contribution margin. Controllable margin is the excess of contribution margin over controllable fixed cost. It do not report non-controllable fixed cost. Let me explain you with the help of a illustration. We have a responsibility report over here and it reports the budgeted and actual controllable revenues and cost. It uses cost volume profit income statement. It deducts controllable fixed cost from the contribution margin. Controllable margin is the excess of contribution margin over controllable fixed cost. Next, let us explain the basis and formula used in evaluating performance in investment centers. Let us first talk about investment center. The investment center is responsible for both profit and investments. The investment center manager has control over revenues, expenses, and the amounts invested in the center's assets. It also formulates the credit policy, which has a direct influence on debt collection, and the inventory policy, which determines the investment in inventory. The manager of an investment center has more authority and responsibility than the manager of either a cost center or a profit center. Return on investment is the primary basis of evaluating the performance of a manager of an investment center. It shows the effectiveness of the manager in using the assets at his or her disposal. It is a useful performance measure. Factors in return on investment formula are controllable by the manager. Operating assets. So the return on investment is controllable margin divided by average operating assets, and operating assets include current assets and plant assets used in operations by the center and controlled by the manager. Average operating assets are based on average operating assets on the beginning and ending cost or book values of the asset. Let us now talk about responsibility report. The responsibility report is affected by the scope of manager's responsibility. Such center is an independent entity for operating purposes. All fixed costs are controllable by the center manager. It shows budgeted and actual return on investment below controllable margin. Let me explain you with an example. The responsibility report is affected by the scope of the manager as already stated. Such center is an independent entity for operating purposes and all fixed costs are controllable by the center manager. It shows budgeted and actual data, and return on equity is calculated below the controllable margin. And you can see the return on investment is the controllable margin divided by the average operating assets, that is 200,000, and same is the case with the this is the budgeted return on investment, and the actual return on investment is less, and that's why it is unfavorable. The return on investment approach includes two judgmental factors. First, the valuation of operating assets, and operating assets may be valued at acquisition cost, book value, appraised value, or fair value. Margin income measure. This measure may be controllable margin, income from operations, or net income. Let us now talk about how we can improve the return on investment. But before that, let us see how we calculate it. So we have the sales, we have the variable cost, and sales minus variable cost is the contribution margin. From contribution margin, we subtract the controllable fixed cost, we get the controllable margin. The average operating assets are 500. So the return on investment is 600,000 divided by the average operating assets, and that is 12%. The return on investment can be improved by increasing the controllable margin or by reducing average operating assets. You can recall that average operating assets are based on the beginning and ending cost or book values of the assets. Let us see how. Now, we can increase the return on investment by increasing the sales or by reducing variable and controllable fixed cost. In the first case, if the sales is increased by 10%, then the sales current sales is 2 million, and 10% of this 2 million will be 200,000. So the contribution margin increases by 45% of 200,000, that is 90,000. So the controllable margin will be 600 plus 90,000, that is 690,000. So the return on investment will be the controllable margin, that is 690,000, divided by average operating assets, so that comes out to be 13.8. Recall that when the sales didn't increase, we have the return on investment as 12%, and now with the increase in our sales only, our return on investment increases from 13 to 13 point sorry from 12 to 13.8%. Okay. Second, return on investment can be increased by decreasing the variable and fixed cost. Now, in this illustration, we assume that there is a decrease in the variable and fixed cost by 10%. So currently we have the variable cost of 1,100,000 and the fixed cost is 300,000. So the total cost is 1,400,000, and 10% of this amount will be 140,000. So in this case, now the controllable margin will increase from 600 to will add 140, so that makes 740,000. So the controllable margin is 740,000, and our average operating assets is 5 million. So now you can see again that the return of investment has increased from 12% to 14.8%. Let us look into one more situation, that is, it can be reduced by reducing the operating assets, the average operating assets, and we assume that they are going to be reduced by 10%. So we have the total average operating assets as 500, so 10% is 500,000. So now the average operating assets is 5 million minus 500,000, that is 4,500,000. We have controllable margin that remains unchanged, that is 600,000. So we have controllable margin 600 divided by average operating assets, that gives us 13.5, and once again our return on investment has increased. Next, let us solve some exercises, and first of all we are going to prepare a responsibility report for a cost center. Now, in the assembly department of Hannon Company, budgeted and actual manufacturing overhead cost for the month of April are as follows. So we have indirect material, indirect labor, utilities, supervision, and we are going to substitute these values. So indirect material is 16,000, indirect labor is 20,000, utilities is 10,000, and supervision is 5,000. So the total is 51,000. The actual are 14,300, 20,600, and 10,850, and 5,000. These are our actual figures, and these are our budgeted figures. So we can compare now that indirect material is less than our budgeted figures. So by 1700, so that is favorable. The total actual cost will be 50,750, and when you compare with the budgeted, from 51 to 50, that means we are performing favorably. So indirect labor is unfavorable as actual is more by 600. Utilities are again unfavorable as actual are more by 850. There is no change as far as the supervision is concerned. So if you see the net effect, the net is 250, and this is favorable. I have put the same calculation in an Excel sheet also in case you find difficult to read my handwriting. Next, let us prepare report in a responsibility reporting system. Now, Foods company organization chart includes the president, the vice president of production, and 3 assembly plants at Dallas, Atlanta, and Tucson, and 2 departments within each plant, machining and finishing. Budget and actual manufacturing cost data for July 2014 are as follows. So we have the finishing department, and we will substitute the values over here. The direct material actual is 41,500, budgeted is 44,000. Direct labor actual is 83,400. Actual labor and 82,000 is the budgeted. Manufacturing overhead actual is 51 and budgeted is 49,200. So we have the information from here, and we can make the total, and the total is 175,200, and this will be 175,900. And we can make a comparison. In the first case, direct material, since the actual is less than the budgeted, so that's why this is favorable, and this is favorable by 2,500. Direct labor is unfavorable by 1,400. Manufacturing overhead again is unfavorable by 1,800, and the net effect is net result is 700 unfavorable. Okay, next we have the assembly plant Dallas, and for the assembly plant, for the Dallas office we have the budgeted figures, and office cost were 95,000 actual and 92,000 budgeted. So we have 95,000 actual and 92,000 budgeted. So we have a unfavorable result here. Then we have the departments machining for the Dallas. Total manufacturing cost is 220 actual. And for machining, it is 19,000 budgeted. Now, for the finishing, we will just take it from the finishing department, 175,200 and 175,900. So the total will be 486,200 and 490,900. We can look into the results over here. Machining is unfavorable by 1,000. and even the finishing is unfavorable by 700, and the net effect is unfavorable 4700. Next we go for the production, vice president production, and we go for the vice president of production office cost was 132,000 actual and 130,000 budgeted. Next we have the assembly plant for Atlanta, and for the Atlanta plant we have total manufacturing cost actual 424 and the budgeted is 421. 424 and 421. For Dallas, we have already the information, that is 486 200 and 490 900. For Tucson, the total manufacturing cost is given to us as 494 actual and 496 budgeted. So we have 496 500 and 494 200, and the total result will be 1,533,700 and 1,541,100. Now we can see now that the production is unfavorable, that is 2000. Assembly plants Atlanta, it is unfavorable by 3000. Even Dallas is unfavorable by 4700, and for Tucson, yes, it is favorable by 2300, and the total result is a unfavorable result of 7400. Once again, I have put this calculation in an Excel sheet in case you find my writing difficult to read. And next, we are going to prepare a responsibility report for a cost center. Now, the mixing department manager of Malone Company is able to control all overhead cost except rent, property tax, and salaries. That means they are not in your control, so they are not going to be in our reports. Budgeted monthly overhead costs for the mixing department in alphabetical orders are given to us. We have indirect labor of 12,000. Indirect material is 7,700. Lubricant is 1,675. Maintenance is 3,500 and utilities is 5,000. The actual cost incurred is given over here, that is 12,250, and then 10,200, then 1,650, 3,500 and 6,400. So when we make the total, it is 29,875 and 34,000. So we can see over here that the difference here is unfavorable by 250. For indirect material, again the difference is unfavorable as actual is more than the budgeted, and that is unfavorable. Lubricants is favorable by 25. There is no effect, no change in the maintenance cost in the budgeted or actual. Utilities is again unfavorable by 1400. So the net effect is that the difference is unfavorable by 4125. Once again, I have put this solution in an Excel sheet in case you find my writing difficult to read. Next, we are going to prepare a responsibility report for a profit center. Now, Albert Company accumulates the following data for the year ending December 31 for its water division, which operates as a profit center. We have the budgeted sales of 2 million and actual is 2,080,000. So this is favorable as sales is more than budgeted. Variable cost budgeted is 1 million and budget and actual is 1,060,000. We have controllable fixed cost budgeted as 300,000 and the actual is 305,000. So we have a contribution margin of 1 million and 1,020,000. And we will subtract the controllable fixed cost, so that is going to give us 700 and 715,000. Let us see how whether the difference are favorable or not. Sales, yes, is favorable by 80,000 as actual is more than budgeted, but variable is unfavorable as actual variable cost is more than the budgeted cost by 60,000, as contribution margin is favorable by 20,000. Controllable fixed cost is unfavorable by 5,000 and the net difference is 15,000 favorable. I have put this exercise again in an Excel sheet in case you find my writing difficult to read. Next, let us compute missing amount in responsibility report for 3 profit centers and prepare a report. Now, Dates Incorporation has 3 divisions which are operated as profit centers. Actual operating data for the division are listed alphabetically are as follows, and you can see that some informations are missing over here. So we have the contribution margin of 250,000, 100,000. We have to calculate the controllable margin, and you know that the controllable margin is contribution margin minus controllable fixed cost, so that gives us 150,000. So that is number 1. Then sales is given as 600,000, and you know that sales minus contribution margin will give us the variable cost, that is 350,000. So we go for the second one now. Then we have to find out contribution margin, controllable fixed cost, but we have the controllable margin of 90,000. We have sales of 450,000 and we have the variable cost as 320,000. So we know very well that sales minus variable cost, sales minus variable cost will give us contribution margin. So 450 minus 320 will give us 130,000. And now it is easy that 130 minus 90 will give us the balancing figure 40,000. So we have the contribution margin and controllable fixed cost. Then we have the contribution margin and given in the question as 180,000. We have to calculate the controllable fixed cost, but we have the controllable margin of 95,000. So 180 minus 95 will give us the controllable fixed cost, and that will be 85,000. Then we are given the variable cost of 250,000. So variable cost minus variable cost plus contribution margin will give us the sales 250 plus 180, that is 430. So that's how we have filled all the required cells, and we go to part B now, and they say prepare a responsibility report for the women's shoes division, assuming that data are for the month ended June 30, 2014, and all data equal budget except variable cost. Okay, so sales will be the same, that is 600,000 budgeted and actual. The variable cost, in this case they say that variable cost is given to us as 350,000. But it is 10,000 less for the budgeted, that means the budgeted will be 340,000. Controllable fixed cost will be the same again, that is 100,000. So we have the variable cost 350,000 and 10,000 less, that is 340,000. So the contribution margin will be 250,000 and 260,000, the budgeted. This is 100,000 and that is also 100,000, and you know that contribution margin minus controllable fixed cost will give us the controllable margin, that is 160,000 and 150,000. So sales, there is no difference, so there is no difference as such. For the variable cost, obviously it is unfavorable by 10,000, and so is the contribution margin 10,000 unfavorable, no change difference in the fixed cost, and the net effect is that the controllable margin is unfavorable by 10,000. Once again, I have put this exercise in an Excel sheet in case you find difficult to read my handwriting. Next, we are going to prepare a responsibility report for an investment center, that is the last center we have talked about. And for the year ending December 31, 2014, Coop Company accumulates the following data. For the plastic division, which it operates as an investment center, contribution margin is 700 budgeted and 710,000 as actual. Controllable fixed cost budgeted is 300,000 and actual is 302,000. So the controllable margin will be contribution margin minus controllable fixed cost, that is 400,000. This will be 408,000, and the difference here is 10,000, that is favorable. Controllable fixed cost difference is 2,000 and this is unfavorable, and the net is 8,000 favorable. Then for the plastic, beginning with the contribution margin, okay, and then we want to calculate the return on investment. So the return on investment is controllable margin divided by the average operating assets, that is 200,000. So 400,000 divided by 2 million, sorry, this will be equal to 20%. This is the return on investment. This one will be 408 divided by 2 million. So this will be 20.4%. And in the last case, it is 8,000 divided by 2 million, and that is equal to 0.4%. Okay. Once again, I have put this calculation in an Excel sheet in case you find it difficult to read my handwriting. Next, let us compute return on investment using the return on investment formula. Now, for its three investment centers, Casper company accumulates the following data. We have the sales, controllable margin, average operating assets, and we have to compute the return on investment for each center. Now we know that return on investment is controllable margin divided by average operating assets. So in the first case, it will be 1,300,000 divided by the average operating assets, that is 5 million. So this will give us 26%. In the second case, it will be 2 million divided by 8 million, that is equal to 25%. And in the third case, it will be 3,600,000 divided by 12 million, and this is equal to 30%. Okay. Next, let us compute return on investment under changed conditions. Now, for its three investments, Casper company accumulates the following data, and the data for the investment center for Casper is given above. The center expects the following changes in the next year. Number 1, increase in sales by 15%. Number 2, decrease in cost by 400. And number 3, decrease in average operating assets by 500,000. Now compute the expected return on investment for each center. Assume center 1 has a contribution margin of 70%. Okay. So in the first case, it is going to increase in sales by 15%. That means our sales will be how much? It will be 15% of 2 million, and that will be 300,000. So there will be an increase in sales by 300,000, and obviously this will increase our contribution margin and controllable margin by 300 times 70%, that is 210,000. So the new return on investment will be 1,300,000 plus 210,000 divided by 5 million. So this will be equal to 30.20%. In the second case, the cost decreases by 400,000. So obviously this will result in a corresponding increase in controllable margin, and controllable margin now will be 2 million. So the new return on investment will be how much? 2 million, the sales, plus in decrease in cost means 400,000 plus divided by the average operating assets, that is 8 million. So this is equal to 30%. In the third case, there is a decrease in average operating assets by 500,000. So a decrease in average operating assets by 500,000 will reduce our denominator. The new return on investment will be the controllable margin, that is 3,600,000 divided by 12 million minus 500,000, the decrease. So this will be equal to 31.3%. Finally, let us prepare a responsibility report for a profit center and compute return on investment. Now, the sports equipment division of Harrington Company is operated as a profit center. Sales for the division were budgeted for 2014 at 9,900,000. The only variable cost budgeted for the division were cost of goods sold 440 and selling and administrative 60. Fixed costs were budgeted at 100,000 for cost of goods sold, 90,000 for selling and administrative, and 70,000 for non-controllable fixed cost. Actual results for these items, these are the actual results. So we have to prepare a responsibility report for the sports equipment division. Okay, so assume the division is an investment center, and we will talk about it later on. First of all, let us prepare the responsibility report for the sports equipment division for the year 2014, and we have the budgeted sales, and the budgeted sales was 900,000. The actual sales is 880,000. We have the variable cost, and the budgeted variable cost of goods sold was 440,000, and the actual is variable is 408,000 and fixed is 105,000. Then we have the selling and administrative as 60,000. So we have 60,000 over here, the budgeted, and the actual is 61. So the total will be 500,000 and 469,000. Total cost. And then the contribution margin, is sales minus variable cost. So that will be 400,000 and 469,000. We have the cost of goods sold, and the budgeted fixed cost was 100,000 and the fixed budgeted was 90,000 and the actual was 66,000. So the total fixed controllable fixed cost is 190,000 and 171,000. So the controllable margin is 400 minus contribution margin minus the total controllable fixed cost, that is 210,000 and 240,000. And now let us see the difference. Sales is unfavorable by 20,000. Cost of goods sold is favorable by 32, as our actual cost of goods sold is less than the budgeted. Then the selling and administrative is unfavorable by 1000. Then we have the total. Obviously the total is favorable when we make the total, that is 31,000. Unfavorable, 31,000 favorable, and the net is difference is favorable, 11,000. For the controllable fixed cost of goods sold is unfavorable by 5,000. Selling and administrative is favorable by 24,000. The total is again favorable by 19,000, and the controllable margin is favorable by 30,000. So that's how we complete this part, and let us go to part B. Assume the division is an investment center and average operating assets were 1 million. The non-controllable fixed costs are controllable at the investment center. So we have the actual 240,000 minus 90,000 divided by the average operating assets, that is 1 million. So this will be equal to 15%. Once again, I have put this information in an Excel sheet in case you find it difficult to read my handwriting. So this completes our discussion on responsibility accounting. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question regarding this session, then please don't hesitate to ask in the comment box or by email, and inshallah I will reply you back. Thank you so much and happy learning.